see a lot of people out there talking about different property types, what to get into, the pros, the cons, the good, the bad, the ugly, working out, what to navigate through. So I haven't actually seen this list. I've got my team to put together a list of all different little things there that I'm going to just refer back to. But, what types of properties are out there, I guess, to start off with? Well, most people think about a property as being a house because everyone lives in a house. But you've got houses, you've got units. If we look at residential in whole, you've got houses, you've got units, you've got villas, townhouses, you've got blocks of units, you've got tiny homes, you've got holiday homes, you've got all different new duplexes, all different stuff that falls under residential. There's good and there's bad inside of that, just like anything. You've got commercial properties, you've got office spaces, just like my office here. You've got shops, you've got motels, you've got factories, you've got storage units, you've got, what else do we have here? Multi-family properties, healthcare properties, all different types of properties in that sort of place. Then from that, you've got land, you've got subdivisions, you've got raw sites, you've got farmland, you've got agriculture. They fall under sort of more commercial sort of terms. You've got retirement villages, you've got over 55s, you've got holiday sort of properties, which you can buy a little room in a holiday property. You've got all different other stuff as well, which I probably haven't broken it down, but there's probably the bulk of what we'd want to be looking at. You've got advertising signage plinths, which you can buy like at the front of offices. You've got the branding. If you drive into the city, your local city, you'll see that all the big offices, whether they be 10 stories, 20 stories, 50 stories, 100 stories, they're not really 100 stories, but however tall they are, you'll see that the biggest ones have bank names on them, right? And you just see the big name of the bank in the sky. It's like, how did the bank own that building? Well, we all want to be a bank, don't we? But, it doesn't necessarily mean that the name that you see on the sky is the owner of the whole building, or they occupy the whole building. They might just have 2 levels out of the building, and they might pay $100,000 to keep the name up the top, which, is their advertising. So, what is good to invest into? What is best for you? I guess out of all of those properties, they all make money in some way, and you want to make sure where the actual risk is, the counterparty risk. So if you're buying a property in a holiday unit, for example, or in a retirement unit or a student accommodation sort of unit, what you'll find is the counterparty risk is very high because you've only got limited amount of people that can go into that property. So there's a big risk when you're going into those sort of assets. So over 55s, retirement villages, hotels, resorts, those sort of things. The counterparty risk is that someone can't live in those properties. The only type of people that can live in there is either a student or either a holiday maker or either a retiree. Now, when you're looking at that, that's based on the fact the risk is associated to what the operator can do. So if no one wants to live in the retirement village because the operator's bad, well then there's no one living in that. There's no demand for it. If no one is coming to the holiday destination because the operator is bad, well then there's no revenue coming through. And it's not like you can go outside of these complexes. So when it comes to those sort of properties, I don't buy them. Yes, I buy motels and hotels and pubs, but I'm buying the whole freehold property, not just one little unit inside of one. If I was to buy one of those properties that I'm talking about, I would want it for $20,000, $30,000, $40,000, $50,000. I wouldn't go over that really, unless it had some considerable upside. Their growth on those sort of assets is not there. When it comes down to the bank, they don't like to lend on those things. That's why there's not growth, because if there's no market or a very minimal market, your exit position is very risky. So those sort of assets are down the bottom of my list. We can go to the other extent and go, well, farming, agriculture, big parcels of land, that's cool. The problem with those things is they don't generally bring in a revenue. And if they do, there's a lot of hidden expenses in there. What I mean by that is either water rights to be able to access water to your property, whether it be the ability to be able to get loans because there's a very small market once again, land tax. Imagine people have a problem paying land tax in a city, right? And they're like, oh, I don't want to pay land tax. It's 20 grand or 10 grand in my portfolio. Imagine owning 1,000 square meters of land, and what would the land tax bill be on something like that? That's something you need to factor in. So there's a massive, expense that's attached to it with very little cash flow. So it's not something that I would recommend for an average person unless you are in the business of either developing that land, you have a strategy for developing that land, or you have a strategy to turn a profit from working on the land. If you're a farmer and you live on a farm, well, then you're not paying land tax because it's not an investment property. It's your principal place of residence. But if it is an investment property, which most of you would be if you're buying it as an investment, well, then you'd be having to pay that sort of land tax. It would be accountable for land tax. So be mindful of that. Then we get to more of the traditional types of property. So whether it be just a standard residential property, whether it be a standard commercial property, they're where I'd like to play in as an investor. When you get to other areas of land, so whether it be building a house of land, building a subdivision, the problem that sticks around that is there's a lot of extra counterparty risk. So one is, what's the market doing? So if it's a flat market, it's okay, but if the market's going up or down, well, then you've stuck with other parameters. So will the builders build on time? We're in a market now where there's so many builders that are going bankrupt, right? There's going to be a hell of a lot more builders in 2022 that go bankrupt, let me tell you that. We're in a market where these builders are dropping like flies, and looking at the building industry, someone could have been building a house for $250,000 last year, but now it's going to cost you $350,000 because the cost of materials are going up. There's a lot of risk. Is the project still going to be profitable now that that has occurred? So these are all some things you need to look at. But most importantly, when you're buying land, A, it doesn't attract a cash flow. So you've got no cash flow. B, it might take you a year or 2 years to complete whatever the project is, subdivision, building, whatever the case may be. But in that period that it takes you time to do that, you've also got opportunity costs. So in that time, your property might make a profit, but if you took that cash from that project and directed it into another cash flow producing asset, then those assets could have gone up as well. If you hold that asset for 2 years, you do your project, you sell it on, you might make yourself a couple $100 grand. You've got to pay tax, you've got to, commissions, all that sort of stuff. And then what you got left over, you've now got to go and try and buy other cash flow producing assets. I'm a lazy investor. I'm a passive investor. I'm not an active investor. I couldn't think of anything worse that I'd have a pressure around me to say, Nathan, you must, finish a project and sell it. Otherwise, you are going to run out of money. You're going to run out of funding. You're going to have to be pressured by the market. On the odd occasion when I do sell, I sell it on my terms. If the market's gone crazy, I'll sell it. If it's not, well, then I just keep it. It's very rare occasions that I sell property, but if you're an active investor, you then have to turn over that property to move on to your next acquisition and redo the whole process again. And you've got external factors there of the market changing, moving, whatever, and you have to go back to the banks and try and beg them to give you the finance depending on the finance environment on the day. So for me, as you all know, I'm just a buy and hold investor. I'm a lazy investor. I just like accumulating assets and I let the market do its thing. When I say I let the market do its thing, I mean inflation. Inflation's my biggest friend. Most people, inflation, it is their risk. But for me, inflation is my friend because I've got all of my assets, I've got all my stock, which is being inflated away. But I've got my debt, which I bought with yesterday's debt that I borrowed, and that's still capped. So the debt is staying the same, the asset is being inflated away, so I can pay off today's debt with tomorrow's devalued currency. So it makes it easier and easier to pay off that debt. So for me, the strategy of buying assets, holding those assets, and utilizing those assets to live off is very, very crucial. And I don't have to perform anything because I know next week the tenants are going to have to pay me more rent, and the week after they're going to have to pay me more rent. So it's just like reoccurring revenue that's passive and more simplistic, and it's just going to continue to go up. So I've got the asset getting inflated, I've got the debt capped at yesterday's currency, and I've got the cash flow that's getting inflated as well.